Hey, Investing Unscripted listeners. If you want to earn 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you can potentially lock in a 6.9% yield until 2028. In other words, no need to worry about the Fed's upcoming rate cuts. With a bond account at public.com, you can earn a 6.9% yield even as rates fall. It only takes a couple of minutes to get started, but you have to act fast if you want to take advantage of some of the highest bond yields in years. Discover how you can lock in a 6.9% yield until 2028 with the new bond account only at public.com/investing unscripted.
Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, sometimes known as Big J. That's Jeff Santoro, the voice of the people. Hey, Jeff.
Hello, my friend. How are you, sir?
I'm good. Apparently, I'm overweight and out of shape.
That's a weird way to start a podcast about investing, but sure.
Well, it actually kind of ties into the show a little.
I guess.
Stages of life, maybe?
Oh, so you're saying you're at the overweight stage of... Well, this has gone off the rails rather quickly.
Even more quickly than normal. So, okay. Meanwhile, back at the ranch, as usual here on Investing Unscripted, the topic for today's show is something that's coming from real life. So a lot of our podcast episodes are based on conversations that Jeff and I have about different things. We try to bring on guests about topics that overlap. The demographics show that a lot of our listeners are similar ages. If they're younger, eventually they'll be the same age that we are now, hopefully. So that's one of the things I think is really interesting about the idea for today's show, which we're tentatively calling Big Changes.
Are we?
Tentatively.
We'll see. We'll see how it goes.
Yeah, tentatively means I'm saying that that's the name, and then Jeff's going to come up with something actually good.
Well, we both know that's not true.
I was trying to make you sound good in front of the people, Jeff. And then you ruined it.
I don't need your insincere flattery.
It wasn't insincere.
All right, moving on.
It was just a lie. Yeah, moving on. Okay. So back to the point, Jeff. We're having a podcast here, and I'm thinking about making some changes.
Yeah. So we had Brian Withers on a couple weeks ago, and he talked to us about changes he made as he is in this sort of in-between time, not retired, but kind of getting close, but he left his corporate job and he's doing a new thing that he likes better, and that kind of stage of life. And we thought it would be interesting to talk about, even if you're still 5+ years away from actually making any changes, like to prepare yourself for being close to retirement, when you're in your mid 40s, like we are, well, I am, Jason's very close to 50. You have to start to...
You had to say that out loud, didn't you?
I did.
Okay.
You have to start to think about, like, what are the changes I will make and when will I make them, right? So you're not all of a sudden saying, oh no, I have to make all my changes right now because I'm this age, right? So we wanted to kind of have like a conversation about how to think about what changes you might want to make at some point as you kind of get into that like first stage of thinking about retirement.
Yeah, that's it. That's exactly it. And Jeff, you said the word that begins with "fi" that I'm not going to say, but I'm 47. I'll be 48 before the end of the year, and 48 is really close to 50.
Yeah.
Right?
Thank you for recognizing it.
The first step to getting help's admitting you have a 5 handle, I guess, in your age. So here's the thing. I've talked about this before, and I'm pretty much an open book with my investing journey. Hopefully my successes and copious mistakes that we talk through a lot help other people avoid those same mistakes and learn some of the valuable lessons to find their own success. And here's where I am. I just want to kind of lay this out because I've talked about it before. This is something I've been thinking about for a long time because I've talked about as I get closer to retirement age, you go from a period where you're really, really focusing on growing your wealth. And a lot of times we think you go from that to, well, you have to preserve your wealth and you start drawing down. And there's an in-between period where the things happen, right? And one of the things I've been thinking about a lot is my wife and I have been very fortunate through our financial success. The good incomes that we've earned, our high level of discretionary income, so that more money to save and invest, plus this remarkable 15 years that we've invested through as we've entered into our peak earnings period. So you put all those things together. And one of the things that I try to do at least once a year is think about working backwards from like a number. And an easy number to use when you start thinking about financial independence is your current income minus any expenses that you wouldn't have in retirement. For example, when you go into fixed income, the first one you can take out is retirement contributions and investment saving, right? You obviously, and if you're contributing 15% today, you back that 15% off, and immediately that's like a good starting point. And then you can start looking at other things.
Like if you might have your mortgage paid off by the time you retire, or you'll
Right.
be done paying for your kids' college by the time you retire, that kind of stuff.
Or you just want to kick them out, right? Whatever.
Either way.
Just make the number 0 next to the child on the ledger. So the point is that I've started doing that math, looking at where our portfolio is now, and the start of invested wealth. So not emergency savings, not our operating cash that we use to pay bills and that kind of thing, but just money saved for retirement and invested assets, looking at those things. So not the home equity, like got to live somewhere. So just things, assets that we could quickly turn into money for some future date, right? So I started working backwards from there and thinking about projected levels of return, and also thinking about what are our likely contributions to retirement accounts over the next 5, 10, 15, 20 years, right? Kind of stretching it out and looking at it. And we're actually getting to a point that realistically, we could very likely consider some form of early retirement within a decade or less, right? So before 60, to put a round number on it. And as exciting as that is, it also, there's a part of me that it triggers that concerns me, because all it takes is the bad timing of one protracted downturn to push that number out years.
Right. Because the thing is, like, there will be another 2022 in terms of market returns. And
Yeah.
if that happens, using your example, if that happens when you are 57 or 58, if you've not made some changes, you're going to wish you had. But at the same time, if you get to 57, 58 and nothing like that has happened for a while, you start to think like, oh, I probably should have stayed in stocks more. So like, I think you have to, I think you have to kind of come up with a plan and stick with it, and try to stick with it no matter what is going on, like,
Yeah.
and to your point, I think that's why you want to try to think about it earlier than later. Like, I know we're going to get more into what you've been thinking, but real quick, just while we are paused here for a sec, I've started to think about this too, not so much from the standpoint of I'm really close to like that number or anything, and I don't want to like go to cash. I don't want to have more bonds, but I've started to think about, do I want to have more in my stock portfolio? Do I want to have more dividend paying stocks? Like, do I want to start building a position in more stocks that pay dividends, so that many years down the road, 5, 10, 15, 20 years down the road, maybe that's enough income to, dividend income to make me not have to withdraw my account as much, right? So, and that's something I think you have to start to think about ahead of time. It's not like you can wake up one day when you're 62, sell, you know, $300,000 worth of stocks, and then just buy $300,000 worth of dividend stocks.
Right.
So that's like the first kind of seed of how I've been thinking about this too. But keep going.
Yeah, no, I think that's exactly right. And I just want to say this too. Probably should have said it about 9.5 minutes ago here, as we're 10 minutes into the episode. But I think the big thing I want to stress is that I think this is the sort of thought exercise that, whether you're 45 or 55 or 35, is useful, because time flies, and you look up and you're planning to retire in 5 years, and we've just gone into a major recession, right? And the market's down. And oh, by the way, the company you work for is laying off workers. And Brian Withers shared that in his situation. He didn't say it on the podcast with us, but he's told me before, the day that he got his pink slip back in 2009 was the Friday that the S&P 500 bottomed. So he was put in a situation without a substantial amount of cash savings. He was almost entirely invested in stocks when the market was down 55% and he was out of work.
Yeah.
And he was probably going to need to sell some stocks to raise money at the worst possible time. And obviously that's kind of a worst case scenario where you're out of work and it's a terrible economy and, the market's down really bad. But there's versions of that that can undermine your plans in lots of other ways.
One of the things that I've been meaning to do, it's been on like my to-do list personally, is to meet with a fee-only financial advisor
Mhm.
because I've done online calculators and I have websites where I like track my investments that will give you like projections on how you're trending towards retirement. And I think those are fairly accurate and correct. As we've been preparing for this episode, I've been thinking, you mentioned that you're about to turn almost 50 and I'm about to turn 45. And
See, I didn't say I was almost 50.
oh, I'm
I
sorry.
said I was almost 48.
Right. Well, those were my words. I apologize.
Your words that are true words.
But so this is the thing I'm thinking now, like maybe every 5 years, starting this year, as I turn 45, my wife's a year younger than me. Maybe I do like a every 5 year check in with a financial advisor kind of thing. Cause that puts me on track for 55, which is like the retirement age I can leave the teaching profession at, and 65, which is like the quote unquote standard retirement age, I think, for a lot of people, every 5 years. And maybe I won't need to do it that frequently, but because I think, you did a nice little projection in terms of like trying to map out like what returns might look like over the next 5 or 10 years. But, for as much as it's probably still good to talk to a professional and get an unbiased opinion, someone just coming in from the outside.
Well, another guest that we had on, Robert Brokamp, with the Motley Fool, ran the Rule Your Retirement service for as long as it's existed. They have a new product called Game Plan that's kind of the same idea, but I think a little more holistic and not just, right at it in retirement. But anyway, this is somebody that spent 3 decades helping build a vast amount of knowledge and experience about this exact topic that pays somebody a fee to do this exact same exercise with him.
And he is a CFP. Like he's
Yeah.
someone you could hire to do this work, and he still has someone else look at his stuff. So I think that's a good.
I mean, this is one of the top, I don't know, a couple hundred experts in the U.S. Right? This is an absolute subject matter expert that hires a professional, and I think there's a lesson to it too. You know what? If you're a plumber, you probably fix your own plumbing. If you're a mechanic, you work on your own car. But if you're a heart surgeon, you go see another surgeon, right? And it's not to say that you can't DIY
Surgery?
financial planning, right? I mean, you can't DIY. We could DIY heart surgery if you just wanted to die. But the point is that sometimes you need another expert to do it. And I think when it comes to something like financial planning, and you're at these steps, there are so many blinders that we can have emotionally, and sometimes it's with our partner, that there needs to be a third party to validate that the person who it's not their full-time job has you on the right path, right?
Yeah, no, I feel seen. That's an absolute thing. Like
Yeah,
I would imagine most people who listen to our podcast are not people who write and think about investing as a full-time job like you do. They're probably
right.
more like me who have, 9 to 5s in some other profession, but this is just something that's really interesting to them. And I think I would be willing to bet there's a lot of people who listen who have spouses that could care less about this stuff. And it probably comes with some skepticism about the hobbyist's knowledge level, right?
Rightfully so.
Right. Yeah, yeah,
Rightfully
yeah.
so.
Absolutely.
Yeah, absolutely. Let me get on the soapbox for a minute about this topic, because I'm talking about all my guys here. I want you to listen up, and I want you to hear me closely. Don't go try to find some financial advisor that's just going to tell your wife that you're right. You have to go into it without an ego, trusting that this person is going to advise you things that you might be doing that they suggest you maybe want to do differently, and you need to listen to them. If you're not, you're trying to find somebody to help you win an argument. You're trying to be right. You're not trying to get it right.
Yeah.
Okay.
Hey, everybody, we'll be right back, but first, a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. And just last thing on this, and then we can dive more into the conversation. Since you mentioned Robert Brokamp, one of the things that he has said many times, I've heard him say, is you want to find a fee-only financial advisor, which is someone who will do the job for a fee and not try to take a percentage of your portfolio. And he always recommends the Garrett Planning Network and the NAFPA, the National Association of Financial Planning something. We will put the links to both of those things in the transcript so you can find them very easily. But those are places to go where you can find certified financial planners who will do this work on a fee-only basis, and they have to act as a fiduciary for you, which means they have to put your
That's the
interests
key.
first. That's the key.
That's the key, is that they're a fiduciary. And what that standard means is that they're bound to only offer you financial services and make recommendations of products that are in your best interest. The vast majority of financial advisors, quote unquote, that's a sales term, by the way. That's not an actual certification. Financial advisor is just a fancy name for a salesperson. Most of them are not bound by a fiduciary standard, which means that they can recommend a product to you, that they know there's something better out there, but they can recommend a product to you. And it's a product that they make higher commissions on. It's totally legal in most places for them to do that. And there's no, I mean, I think it's morally corrupt to do it, but they can. So be aware of that. That's why it's important to have a fiduciary. So
now that we covered
now
that we covered what you should do, which is hire a professional, talk about what you're thinking about doing with no professional guidance.
So, but I have had some professional guidance, and we talked about this a little bit when we were texting about it. You told me exactly what we just told our listeners there. And my kind of glib response is, I work out with a CFP, a certified financial planner, every week. And your response was, pretty sure it was an eye rolling emoji and something along the lines of, don't let your sweaty weightlifting bro, just agree with you or whatever. It's like, you need to find somebody objective, right?
Yeah.
And I think it was really good advice. It's a good reminder. Sometimes it's handy to have somebody in your life to do that too. So here's what I've been thinking about doing. All right. So again, the background, man, it's been a great 15 years to be an investor. That's been supercharged by a higher level of disposable income that we've had, that we've been able to invest more than the average, which has worked out pretty well. And so kind of the short version here is I'm working backwards and looking at the numbers from where we are now. And if we see over the next, these are somewhat fictional numbers to protect the innocent, if we see around a 5% rate of return over the next decade, 12 years, with our current levels of contributions, we'll hit our retirement number in less than 12 years. So 5% is a pretty low threshold, number one. Number two, you never get just 5% a year, just like you never get just 10% a year. Sometimes we get negative 20, sometimes we get plus 35. And I've started to think more and more, because again, I'm almost entirely stocks, I have cash, but I'm beginning to think maybe it's time, Jeff, to start accelerating my transition of part of the portfolio into bonds.
And I think what's interesting about, well, I want to ask why bonds and why not other things in a second, but I just want to say before we do that, the fun part of this conversation for me is that you and I have very different, well, ages. You're a lot older, but besides that, we have very different compositions of our portfolios, right? Like you just said, you have some cash on the side for investing, again, separate from your safety net cash, and then you have bonds. I mean, stocks. That's your whole portfolio. Whereas like if you combine our stuff, it's mostly index funds and ETFs with some stocks. And then I have a pension, which I was telling you as we were planning, like I heard someone recently say, if you know you're going to get a pension, which is very few professions anymore, unfortunately, you can kind of think of that as, I know it's income, which is always how I thought about it, but someone framed it as the cash portion of your investment portfolio, right? So I know a lot of people in retirement will keep, I know some people just from like discussion boards on the Motley Fool have said that they keep 5 years of their expenses in cash in retirement. So I'm just picking a number. Let's say you have $100,000 a year you need for expenses. They have $500,000 in cash for exactly what you would expect. Market downturn, I'm not selling stocks at the bottom to pay groceries. People with pension income can be that part of their portfolio, right? Because it's guaranteed you're going to have it, which was an interesting way to think about it. So I'm not thinking I don't think I'll be in a position of thinking about transitioning to bonds like you are, but that's not because it's not a smart move. It's because the composition of my expected retirement portfolio is very different than yours.
Yeah. And so here's how I think about bonds. And there's a couple ways you can think about it.
But
So
they're all boring.
Oh, so boring. So boring.
This is the section you don't want to skip, but you probably want to listen at like 1.75 speed or something.
Yeah, maybe even 2x. But then you can't really understand Jeff if you go that
That's
that
true.
fast.
Yeah. New Jersey people are hard to listen to on fast speeds.
Yeah.
You sound great. I have to say, I listen to you on other podcasts at like 1.75. That's the perfect speed for you.
I sound normal. I sound like normal people at that speed, I'm guessing.
Yeah.
So the way I think about stocks is they're like the ceiling, right? They're the growth. You can just really go super duper high ceiling. And we've talked about it before, Jeff, where as individual investors, based on your time frame, right? You have a long time frame. Volatility isn't a risk, right? It's more likely to be an opportunity than a risk. And that's still broadly the case for me. Even 10 years from now, let's just say everything goes swimmingly. And we decide 10 years from now, it's time to punch the corporate ticket and move into maybe not full retirement, maybe more something like what Brian Withers has done.
You just coast on that sweet podcast income at that point.
Yeah. Yeah. Thanks for listening to our ads, people. Click on the links. The point is that even at that point, I'm hoping to live another 20 plus years. I'm going to still count on owning stocks and growing that wealth to continue to afford the lifestyle that we're going to want to enjoy in retirement, right? And then when I'm too old to enjoy that, to pay for a really nice senior facility.
Yeah, super
right?
nice.
Yeah. Not the beds in the hallways ones either. I mean, like the really nice ones. The beds just in the rooms, maybe with another person in the room. Man, this one's off the rails. We're a mess today.
Yeah.
So that's going to continue to be that reality. But again, thinking about like the whole premise of risking what you can't afford to lose to try to gain what you don't need.
Yeah.
I want to be mindful about that with kind of where I am with the wealth that we've created so far. Because again, it's a pretty low threshold of returns that we need to generate over the next decade to be in a really good position. I'm really fortunate to be there. And I don't want to make the mistake of ignoring the uncontrollables that have led to this success, right? The zero interest rate environment. And I'm not talking about just 2020 and 2021. I'm talking about all the way from the great financial crisis, all the way leading into the pandemic was an exceptionally low interest rate environment that created this opportunity for low cost of capital that a lot of really great companies leverage to great returns for stock investors. The story's changed now, Jeff. It really has. Even cash, you can get 4.5% yield pretty easily on. You get into investment grade corporate debt, you can get 6-7% treasuries, 10-year treasuries, you can get pretty good yield, and it's as rock solid as it gets. So I think it's time to start making that transition.
So here's my question though. The assumptions that you laid out for how long it'll take you to get to that number that allows you to retire, does a transition to bonds prior to that point slow down that timeline?
Yeah, and that again, based on the assumptions that I'm making about the potential returns right now, I don't think it would, because so again,
because you're expecting 5%, which you're thinking is kind of conservative. Is that why?
well, I mean, that's it. Starting from the beginning of this year, going through to my age 60 year, the math that I'm using that's kind of driving my thinking is actually 4.2% average annual rate of return is what I'm thinking about. Based on that math, Jeff, I could move my entire portfolio into 10-year treasuries,
Right.
and hit that threshold.
And I think I want to pause there because I think that's an important thing for people to consider because, again, not an expert here, in case anyone was wondering, but you hear bandied around often that the average return of the stock market is 10%, and it has been historically. But I've also heard a lot of smart people say it would not be unreasonable to see the next decade underperform that average. And because for all the reasons you just mentioned, like for as long as you and I have been adults thinking about money, interest rates have been historically low. And let's say for the next 10 years, interest rates don't go much below where they are now, maybe a point or two. Does that mean the next decade of returns is, much different? So like, I think I like the way you thought about it with 5% as a hurdle rate, because that's half of what the quote unquote stock market gets, right? So like, that's a pretty conservative number to think about. And then the nice thing about that is if the market does continue to do well and you overperform that, it speeds up your timeline. And if it doesn't, it just slows it down a little bit. But I think using a conservative number, I think, is smart, because you'd rather err on the side of having the money too soon than not having it when you need it.
Yeah, no, that's exactly right. Well, and there's another part of this that's guiding my thought process too, and that's there is a world in a world. There is a world where we go through a 5 or longer year period where returns are zero, right, from the beginning to the end.
I
Like
think
the
it's, yeah.
1970s,
Well,
for
not even just
example, was
that.
a
Like,
lost decade.
not
From
even just that.
2000 to 2007 was a lost 7 years.
Right. Yeah.
And then again from that 2007 peak, when the market started selling off again, it was another 5.5 years for the market to fully recover.
Yeah. I think it's easy, especially for newer investors. Like, again, if I had come to investing entirely in 2020, like I did to stock investing in 2020, like if I was right out of college in 2020, I might think that all market crashes are no longer than 18 months, because the only thing I lived through was the pandemic flash crash, and then 2020, which was about a year and a half ish, right? But yeah, if you just mentioned a couple of those longer, if you go peak to trough on some of these older or longer ago recessions and stuff, it can be 5, 7 to 10 years. It's not always guaranteed to be like a year and a half.
Yeah, just as an example here, from January 2000, the market started selling off, and then it returned to the all-time high in late 2007 for like 10 weeks. And then the global financial crisis started, and it was still below the all-time high in 2013. Now, that doesn't include total returns. So you include dividends in, and it was only 11 years,
Only.
with the exception of a couple of months in
Right.
late 2007, when it was at highs again before it sold off again.
Well, so let me ask you this, because you just mentioned dividend stocks, and I referenced it earlier too. So when you think about ways you can start to think about transitioning your portfolio into a little bit more preservation and a little bit less appreciation, why bonds? Why not things like T-bills, cash, CDs in a high yield savings account,
Yeah.
or even just dividend stocks? Or do you think it might end up being, in actuality, when you actually do these things, it might end up being a combination of all those things?
Yeah, no, it's absolutely going to be a combination of these things. So like, for example, if we start with my portfolio today, the barbell approach that I've taken and the portfolio that I've built is it has become, I've increasingly invested more capital into buying dividend stocks.
So you kind of already started your transition without even kind of consciously starting it.
Yeah, no, it's true. It's true. And it's 10 years in the making that I've been kind of shifting away from just a growth focused investing mind to buying more dividend, particularly dividend growth stocks, right? There's a good number that are higher yield, but really ones that have a good history of growing that dividend over time, is because, I mean, those are the companies that like they're just companies that grow their dividend. They already have accomplished all the things and they're growing and they have moats and they have margins and they have market share and they have tailwinds because they grow their dividend every year, which means that they have a board that's smart enough to take the reins away from management to make bad allocation decisions. So they
Right.
return more of it to shareholders. So all of those things to say, like, I've already started that process. And so this wasn't exactly the question you asked, but I think it's inferred in what you were saying is, why not more dividend stocks, or why not more like income investing assets like that? And really it's about being mindful of over leveraging to stocks in general with tying up the capital. Because when I'm thinking about the portfolio that I'm building and withdrawal rates, thinking I'd withdraw, between 4 and 5%, that would be, I would need to see the entire portfolio yielding 4 or 5%. And there's a lot of companies that I own that my anticipation is that a decade from now, they're still not going to be paying a dividend. They're still going to be growing. Right. And I don't want to push myself into a corner where everything that I own is exposed to the market's volatility. And again, it's kind of the same situation, which brings me back around to bonds.
Yeah, because I think if I'm understanding it correctly, like you're that money is less tied up permanently, right? Because at some point you're getting the income from the bond, but when the bond matures, you also get the principal back. If you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part? If you act now, you can potentially lock in a 6.9% yield until 2028. The new bond account, only at public.com/investing unscripted.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
Yeah. So we'll do Jason's bond knowledge corner now. So let's all go sit down, kids. And Chris,
Can you do it in 2 minutes or less? Because it is bonds.
Yeah. So stay awake. Stay awake. We're going to pass out the espresso shots first. Everybody got their espresso shot?
It says in our show notes for this, or for our planner, it says in less than 2 minutes.
I know. I'm not starting yet. I'm starting now. I'm watching the clock. So owning bonds versus bond funds, ETFs or mutual funds or whatever. If you own a bond fund, you don't own the bond. You're an investor in the fund. The fund owns the bonds. The price of the fund, the ETF or the mutual fund that you own, moves up or down based on the value of the bonds, the secondary market value of the bonds, not the value of the bond when it matures.
Right. What you could sell it for that day.
The difference is if you buy a bond for $1,000 that pays what equates to a 4% yield, you're always going to get a 4% yield. But if interest rates move higher than that 4% yield on comparable bonds, and you want to sell that bond, you're going to have to discount it. Let's say interest rates move up to 5%. You'll have to discount the bond so that what somebody is buying it from you at, it would yield 5%, right? The beauty of owning the bond is if you don't need to sell the bond, you don't sell the bond,
Right,
and you're happy just to get the income.
You just hold it to maturity.
And then it matures and you get all of your money back, assuming that the entity that issued it can afford to pay it off, right? this is where treasuries are beautiful because of the full faith and backing of the federal government, right? When you also print the money, you can find the money to pay back the bond, right? So that's the beauty of treasuries. T-bills, short term, that's like the short term stuff to like the 30-day stuff all the way up to the 10, 20, and 30-year treasuries. It's the safest money in the world, right? You can get investment grade corporate debt as well that's good and that yields higher. So if you're dealing with large enough amounts of money, because usually you buying bonds, you're not going to buy less than $1,000 at a time of a single bond. You can build a portfolio of bonds that matures in such a way that when you need the cash, the bond will mature and you can get the cash,
like
right?
a bond ladder, like a CD ladder, but with bonds.
Exactly. So it's giving you income, once a month, once a quarter, every year at the beginning of the year, the end of the year, whenever you need the income, right? You can buy the bonds that mature based on what you're trying to accomplish. Like I said, the same way you build a CD ladder. Now, something we talked about when we were planning, when you own that bond fund, it trades up and down based on changes in interest rates. That's why investors that owned a lot of bond funds got wiped out, 20, 25% losses in bonds a couple of years ago when interest rates skyrocketed. Because when those rates went up, the market value of those bonds went down. Right. So we're in a different place in the bond and the interest rate cycle right now where as I'm making this transition, Jeff, honestly, I may buy bond ETFs, some mix of ETFs and maybe some individual bonds because we're in an environment where interest rates are going to be falling more likely than they're going to be going up. So I'm not concerned about getting wiped out in the same way.
Yeah, no, that all makes sense. I like the idea of thinking about the bonds. Like I hadn't thought about this till we just talked about it. I like the idea of thinking about staggering the bonds like a ladder because it's to me it's like the same point about having enough dividend income that maybe that can cover your bills, right? Like if you're able to have so much dividend income in your retirement that you can pay all your bills all year round, either entirely or mostly from dividend income, then logic would dictate that's less things you have to sell out of your portfolio for cash. Right. And I think you could look at the bond portion of a retirement portfolio as serving the same purpose if every month, 3 months, a year, 6 months, whatever you set it up as, a bond matures and you can decide at that point, I need this cash now to pay my bills, or I'm going to use this cash to buy another bond or put it in the savings account or whatever you decide to do with it. So that's an interesting way to think about it. So, all right, I got a question. What do you think what do you think this is the next thing you're going to do? Actually start making some changes or double check your plan with a professional?
So I've been talking to this close friend of mine that this is his full-time job is advising people. So I'm going to have some more conversations there. But the plan that I've kind of laid out in my brain is to immediately, and immediately doesn't mean tomorrow. It means in
While
the
we're recording.
Yeah. No, I actually started before the
Every
market
time
closed.
I talk, you buy bonds.
I do. That's exactly right. Right. No, but to immediately begin the process of shifting 5% of the portfolio into bonds. And that's a process that I expect would take 3 to 6 months. I'm not going to rush it. I'm going to be thoughtful about what I'm doing, make some hard decisions about which bond funds I would want to invest in. If I'm buying individual bonds, what bonds I would want to buy, because there's all kinds of, just like with options and just like with mortgages and just like with every other kind of financial contract out there, you can buy a 30-day T-bill, you could buy a 30-year treasury, you could buy like 20 and 30-year debt that Microsoft and Apple issued, right? There's all kinds of debt of all kinds of terms out there, and it can get just as dangerous as penny stocks if you don't know what the hell you're doing. So it's really important to be mindful about understanding the risk profiles, thinking about timelines, and then allocating appropriately. And we've talked about this before, Jeff, is I don't just have 5% of my portfolio laying around that I want to transition this over. I have more than 5% of my portfolio in cash, but that's not sitting there necessarily just to start transitioning it into bonds. So I'm going to need to start thinking about, do I want to start trimming some of my positions? Is that going to be selling part of my biggest winners, trimming the weeds, a little bit of both? Like there's still a lot to think through about how I want to do this.
So that's why I think if it were me and I was trying to do what you're trying to do, one of the questions I would have for a professional is at what rate should I do this? Because I could see a scenario where it would actually, I like how you're thinking slow and steady, right? Do this over time, little bits at a time. But I also worry that you could end up in a position where more of your portfolio is in safe stuff too early. And
Yeah.
you could end up, so I would be curious, like if I was talking to a certified financial planner right now about this topic, one question would be, is it better to just do this quickly? Right? Is it better to figure out, okay, this date is 5 years before I want to retire, or 7 years, or whatever the right date is. And then within 6 months or 3 months, the whole transition happens
Right.
versus spreading out the whole transition over a decade. Like I would want to know, like, what's the right way to do it? So here's another question I wonder about. What major market events could make you change this plan, if any?
I don't I don't know that there is necessarily a major market event that would make me make that change unless we saw a substantial sell-off.
Yeah, like so let's
Um,
say we saw a massive drawdown in the next 6 months. Like
yeah,
let's say the stock market drops 30% between now and 6 months from now.
right.
I would imagine you'd say to yourself, I can start this plan next year.
Well, 6 months from now, based on my current thinking, I'd be done with this, right?
Yeah.
I mean, realistically, I'd like to have most of this done by the end of the year, if I'm being honest, within the next 3 months. And part of my thinking is tied to this. I don't want to get caught up with timing the market because I mean, the market's down a little bit the past couple of days, but it's still within 3% of all-time highs. So, I mean, that's kind of means maybe it's a good time to do it. But you know what comes before all-time highs? Previous all-time highs, right?
No, I wouldn't expect you to change your plan on a regular,
Yeah.
there's all the statistics, right? Like once
Yeah,
a year, you see a 5% drawdown, and once every other year, you see a 10%, whatever the numbers are.
right,
I'm not accurate, but I'm directionally correct.
right.
I'm talking about like the once every 5 or 10 year event. If
Yeah,
that were to
yeah.
happen as you were just starting this strategy, I'm curious if that would make you delay it a little.
It very
Logically,
well
it seems like you should because you're still far enough away where,
it could. Yeah, no, I think you're absolutely right that it definitely could. But one of the reasons that I'm trying to be mindful about not just taking the cash that I have and just buying a bunch of bonds. You know what I mean?
yeah,
Um, and being thoughtful about the fact that that cash exists for a very specific purpose inside my portfolio. It's the dry powder to let me act when the market gives us those opportunities once a year, once every 5 years, once every 15 years, right? That we see those substantial drawdowns happen. So yeah, I guess what the biggest thing that I've got to work my way through is what is the best way to generate the proceeds that I'll be using to transition into bonds, like that initial 5%, so
yeah.
that I'm
Because
still in a position to act aggressively when we do get those market downturns.
well, that's interesting because like that, if you're in the process of this transition and one of those big drawdowns happens that triggers your cash rules, you might as well just move that investing cash straight to bonds
Well, no, because then
rather
it would
than,
no, because then it wouldn't be in
oh, I
cash.
get, yeah, no, I see. No, I'm saying like what I just said was stupid now that I think about it. But like directionally, this is where I was going. You could theoretically simultaneously be buying stocks at a discount and then selling stocks to buy bonds.
Right, right.
That's
So
what
I
I meant
think,
about you might as well just put the cash into bonds, but
yeah,
getting into
no,
the
that's
weeds so we can.
but that points that I think your point is a good one. And that's one of the reasons I'm doing this now is because now is the time that I can choose to do it
Versus you have to do it.
versus I have to do it. And it's a terrible time to be
Right.
doing
Yeah,
it.
yeah, yeah. No, that part I understand.
Yeah. Yeah. But no, these are the kind of things that I have to be thinking through. And the biggest thing, and this is the biggest mistake I'm trying to avoid, Jeff, learning lessons from people that you and I know that saw significant portfolios back in 2021 become, 60% smaller
Right.
over a 2-year period. And, I'm in a position right now that the market's back to all-time highs. So fortunately for a lot of people that saw those losses, they recovered a lot of it. But I want to be actively making these choices now instead of waiting too long to be forced to be making those. I want to be making the decisions coming from a position of strength versus a position of weakness. So that's really what I'm trying to do.
Yeah, no, that makes a lot of sense. All right. Well, listen, I know we did actually plan this one out, but this was a fun kind of off the cuff conversation. Like we went in a lot of different places that we did not plan to go. And I think that was interesting to kind of pick your brain on what you're thinking here. So I hope people enjoyed this little journey into Jason's thought process. This is as close to being inside Jason's brain as anyone wants to be, I think. Just fair to say.
Yeah, that is the correct phrasing. That is correct. Now, okay, wake up, everybody. Wake up. We have to do the disclosure now. Here goes. Jeff and I love to give our answers to these hard investing questions out there. Talk about our transitions in life and the fact that I'm near 50. You might be near 50, but just because I'm near 50 doesn't mean that you also have to be near 50. Find your own answers, people. It's a metaphor. You can do it. All right, Jeff, my friend, we'll see you next time.
I'll see you next time.